A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The banks could face a liquidity crisis soon. The evidence will shock you. We may soon see another financial crisis. Let's start with the alarming news headlines. So what is highkey funding? And why is it alarming? Highkey funding spreads indicate cash shortages. Since cash is scarce, this has caused a banking system liquidity crunch. The collateral is insufficient. Due to its high collateralization, the American banking and financial system uses pristine collateral extensively. Treasury bills are mandated since there isn't enough collateral. Liquidity and collateral shortages indicate a serious financial system problem. Additionally, the U.S. started this issue. There are Treasury securities because banks will lack quality collateral, as many of our short-term loans are refinanced into longer-term ones. Everyone rushes to get collateral in case the system crashes and regulators find out. Unless they do, things will quickly collapse. Fire sales are happening because banks lack collateral. These headlines indicate that the system is broken. One example is secured overnight lending rate data. This is a standard overnight loan rate calculation. Key phrase, backed by Treasury securities. If this rate rises, it appears funding is insufficient. I fear collateral shortages are the real issue. That's why prices are rising. Financial institutions that need collateral immediately to do what? Why would they need it? Is it because they have a regulatory issue at the end of the year? Does everyone run around trying to gather as much collateral as possible because the financial system is failing? That was clear over a month ago, before the Fed's unexpected dovish turn. This is a Fed overnight reverse repo. More on this later, as more people wonder when and where the Federal Reserve's reserves ran dry. The number dropped below $900 billion for the first time since June 2021. This indicates a system malfunction. Similar to before the global financial crisis, banks lost money. Breaking points occurred due to the collateral stampede. Rates dropped completely. Our short-term open market operations include reverse and short-term repurchase agreements that temporarily increase or decrease bank reserves and affect federal funds market trading. The short-term loan is from the Fed. You're offering collateral for what? We should examine it. This occurs when the Federal Open Market Committee authorizes the New York Federal Reserve to sell a security. A security must be sold to an eligible counterparty, with the seller agreeing to buy it back the next day at a specific price. U.S. Treasury securities are the only securities allowed in this deal. This matters most. Due to collateral shortages, money markets use overnight reverse repo extensively. Let's look at a graph. The Money Market Act requires collateral for all money market funds. What collateral? It could be almost anything per law. Though not explicitly stated, the law requires a Treasury bill. We know there isn't enough collateral when this overnight reverse repo happens, because money market funds use Treasury bills as collateral. This means they're always needed. Therefore, they contact the Federal Reserve, which lends Treasury securities overnight. However, everyone is rushing to get it. Since banks demanding collateral is a sign of a serious system problem, this unexpected increase has everyone on edge. Reserve repo dropped to a multi-year low of $765 billion. A rapid increase in secured overnight financing rate decreases reserves. Alternative, a collateral shortage could start quantitative easing earlier than expected. That explained the sudden dovish pivot by the Fed in one single month. Interest rates are falling, which is good for the market. The strong stock market performance interests you. You should pay cautious attention to this because if the prediction of an impending Fed pivot is correct, it would indicate that the central bank is aware of the banking system's flaws, having built it when the public was led to believe that inflation would be the only problem. Again, the system is broken. Thus, a liquidity crisis will lower rates significantly. Rate cuts and quantitative easing by the Federal Reserve will cause a complete collapse. The connections are now obvious. The collateral is insufficient. Approximately $300 billion left smaller banks this year, while $800 billion left larger ones. Deposits have never dropped so much in a year. Money markets can meet depositors' demand for higher rates because they offer competitive rates, but banks cannot due to the massive unrealized losses in their Treasury security portfolios caused by the Federal Reserve's rapid rate hikes. The funds rate and small bank reserve ratio will drop to zero during the next crisis for this and other reasons. The system is clearly malfunctioning, so this may be the main issue, because the Federal Reserve's beta p-pi falls short of 136 billion. Small banks are in trouble and large banks need cash. As is known, small banks struggle with liquidity. Problems plague them. In dire straits, they're borrowing from the Fed for a year. Smaller financial institutions may be failing. The downside is that another credit crunch is about to happen. This is especially true if the Fed ends its BTFP bailout fund, which is currently giving banks free money. The BTFP was created by the central bank on March 12, 2023, after Silicon Valley Bank failed because customers took out more cash than the bank had on hand. The Fed said at the time that the extra money was meant to help assure banks have the ability to meet the needs of all their depositors. Thanks so much for watching. If you enjoyed this video and found it helpful, don't forget to give it a thumbs up and hit that subscribe button so you won't miss out on future content. Your support means the world to me, and it really helps the channel grow. If you have any questions, suggestions, or just want to say hello, feel free to drop a comment down below. I love hearing from you. And remember, the more likes and subscribers we get, the more awesome content we can create together. Until next time, stay awesome, stay curious, and I'll see you in the next video.